Well, first of all, let's go to David Telstra. Rather unusual performance there today. We saw that 10-year bond yield drop to from 3.6 to 3.25%. And as we were coming on air tonight, we've just had news on Bloomberg that the Germany's auctioned 10-year bonds at a record low of 1.28%. Now, what does that tell you about where interest rates are going here?
Well, it's I think with the move in gold from over $1,900 20 months ago to the current sort of $1,350 or thereabouts, and those long bonds selling at record lows, what it's telling you is that the world is starting to fear deflation once again, and so there's obviously a chase for secure yield, and Telstra's 28 or 29 or 30 cents of dividends a year, you know, seems reasonably secure with the largesse of the federal government, and so I think there's a chase for sort of relatively secure yield with these bonds at such record lows.
Well, we'll move on to our first caller, who's Mark from Budrum. Mark, welcome to the program.
Evening, Kim. Thanks for taking my call.
Yeah, well, I hope you're going to ask a question about the elephant in the room, which is the gold price. So go ahead.
You are, yes, yeah. I'm just wondering, I'm underweight in anything gold. I've only got a little one, robust ROL. Made a bit on that here and there. But I was just wondering, is it a good time to get into, you know, Silver Lake, Newcrest, or what do the panel think? Have they got a gold stock they like, or where do we think it's heading?
Well, the $64 question, as David was alluding to, you know, we've had a bounce in the gold price, but no one seems to believe that by going by the action in the market today. But I mean, it's a really difficult thing to say. Where's the gold price going to trade? And it's going to be somewhere between possibly 1350 and 1450 in the short term. But the bears are really predicting that it could fall as low as $1,000. Are you as bearish as that?
Look, it's absolutely impossible to say.
Well, correct.
I think it's worthwhile just touching on a bit of history, if you don't mind.
Yeah, sure.
Look, gold in 2001 was under $300 an ounce. By 2011, it's over $1,900 an ounce. So it's gone up by 6.5-fold in a decade. It's come back from 1,900 to 1,350. It's bounced a bit. But let's go back to the 1970s. In the 1970s, Mark, gold started the decade at 35 an ounce, got all the way up to 800 an ounce 10 or 11 years later. But during that massive bull market in the 1970s into about 1980, it still managed to halve, at least on one occasion on the way through. It went from, I think, for memory, $400 an ounce to $200 an ounce, but it was still in this massive structural bull market. So we don't know till later. Is this the beginning of a bear market or just a pullback in a massive structural bull market? Now, if you think it's a pullback in the middle of a massive structural bull market, then some of these stocks have got to levels, particularly yesterday and today, which indicates that they're just not going to earn a cent. However, if you are a believer that we are very like the 1970s in a massive structural bull market, and for that to occur you've got to be a bit of an inflationist, then you'd be buying quality stocks like Silver Lake would be a simple example.
To come back to the theme that we're talking about with the four banks and Telstra, what we call the Type 5, and you know the net yield at the moment is around 5.4%. When you look at the when you look at a net yield of say 5% on ANZ, it implies a share price of around 31.20. You look at CBA, you're getting into the 70s, and if you drop that to 4%, you know, you blow right off into the 80s. I mean, it's quite scary. In fact, the price appreciation there. 5% gives you 37.20 on NABs, 34.40 on Westpac, and 5.60 on Telstra. The interesting thing with this deflation that's occurring coming out of Japan, you've got two streams of capital which are actually chasing a scarce asset. You've got the offshore capital, which is obviously borrowing at zero interest rates and coming into our market looking for a place to park cash. Yes. Plus you've got the domestic super SMSFs that are chasing yield, and will be more so if rates come down. Yeah. You know, the market is actually struggling to make new highs. You reckon we could see a bit of a bubble start to develop in this very, very quickly, or is it going to be more of a gradual push?
What I feel is that we've seen PE expansion really since the June levels of about 4,000 on the index. And what we've seen is that the market sort of rallied quite hard from roughly 4,000 into the sort of 5,200 type area, and that took about 8 months. And that really for us was a PE expansion story. What we've really yet to see in a very significant way is an earnings growth story come through in any sort of significant way. So we'll be looking at the results coming out in August for the year to 30th of June 2013 to see if those earnings are really growing. And I think it's going to be very selective. I think high quality stocks, particularly high return on equity businesses that have high return on incremental equity, will continue to grow their earnings at 10-15%. But I think there's going to be a lot of stocks that are really going to struggle. And I think what will happen is that we'll end up with this market really polarised, and the good quality stocks will continue to be bought, and the less good quality stocks will probably have to mark time.
Simon, I'll come to you in a second, but one of the stocks that appears with the biggest gross yield at the moment, nudging 9%, is Myer.
Yes.
So what are your thoughts there? I mean, retail's been struggling. We had the Harvey Norman figures out today.
Yes.
It's obviously priced there for the risk. Is it worth taking the risk?
I wouldn't. I think it's sort of got structural issues, and I think I think you'd fill your portfolio full of 20 decent stocks where they don't have structural issues. They've got strong earnings growth. They've got high return on equity. And I think the thing is, if you're playing in this space where there's stocks with structural issues, then what you're really doing is you're speculating. And Australians love a spec. But if you're going to go for a spec, go for a gold stock that's not making any money at $13.50, but making plenty at $14.50. You don't need to go for a company like Myer that's that's structurally challenged.
All right, Simon, we'll have to wait for you to get your comments on Myer after the break, and so we are going to take a break. But before that, though, it is time to start the Stockwatch, and David, you're on again. And what are you watching? And your time starts approximately, well, now. Here we go.
At Montgomery, we continue to like the reject shop. TRS is the ASX code. During the Queensland floods, it went down to one distribution centre. That's now over. It now has two distribution centres. Margins are improving. We think it'll have a 30% return on equity, and net earnings can quite easily go from 17 million in fiscal 12 to probably 35 million by about fiscal 15. We think it's got 20% upside and an A1 quality business, the reject shop.
.au.
David has been waiting on very patiently. David, welcome to the program.
Thanks, Kim. Now that David's had his rest, these questions are probably for him. Two stocks. First one is Cedar Woods property. I know Montgomery follow this one. I was just wondering if he thinks the price is still reasonable and whether the prospects look good. The other question I have is around Codan, which has been belted in the last couple of days because, amongst other things, its metal detectors are used for gold prospecting, but it just seems like a bit of an overreaction given they're into a lot more other things than just gold prospecting. So is it a good time to be accumulating more of Codan as well?
David.
Okay, well, firstly, on Cedar Woods, we continue to be positive on the space. We've got an intrinsic value going out a few years of sort of high $6, $7 type share price versus the current $5. However, it's obviously a space where the predictability of earnings is not particularly high.
This is in property development, is it?
That's correct, yeah. So it's basically a property developer. As I say, the predictability is quite low. So, although we have a valuation of sort of high 6s, 7s going out 2 or 3 years, I wouldn't sort of be overly sort of. I'd be quite cautious on that particular play. On the story of Codan, as you quite rightly say, it makes metal detectors. Look, I just should declare we did own Codan. We sold out of it at CDA. Is its code. We sold out of it at between 360 and 370, simply because of two factors. Firstly, its predictability of earnings is extremely low. The management last year was expecting it to earn about $40 million for this year to June 2013. 2013. In fact, it now looks like it'll come in at closer to $55 million for the year to June. So its earnings were upgraded by about 35 percentage points. And the stock rallied very hard from the sort of high $2 area to the high $3 area on the back of that. There's the chart on the television, as you can see. We just felt that what happened was, with the predictability of earnings being very low, it could actually peak in this year to June 2013, and so we decided, let's just cut our profits and lock in that profit, which we did at 360, 370. As you quite rightly say, it's come back to 295 very aggressively. We would prefer to look at it, particularly with this bear market or short-term bear market in gold, we would prefer to look at it at probably under $2.50.
Simon, have you looked at Cedar Woods at all?
Not at all.
How does the what's the situation with, obviously Cedar Woods, one of the imponderables here is the level of housing starts, and that being at a very low level. I guess that's one of the unpredictable aspects in terms of taking into account the earnings of this particular company.
Yeah, I think you could make that comment about a lot of developers, and not only just property developers, but any sort of developer. What we see with this company is a business with basically no indebtedness, excellent, pretty good return on equity, shareholders' funds that are growing, intrinsic value that's rising constantly, and I'd say in its space quite a good quality business. But let's accept that predictability is not high.
Yep.